The host of Wall Street Week, David Westin, joins us every day here ahead of the big show, which airs right around 6 p.m. New York time. And you actually had a chance to sit down with former Treasury Secretary Larry Summers. Yeah. We should point out you also had a chance this week to sit down with Fed Chair Jay Powell. And I'm told Summers had some thoughts on what Powell had to say.
Exactly. We thought we had these two things. We should put them together. And so we asked Larry what he thought about what we heard from Chair Jay Powell. And by and large, he thought there weren't a lot of issues. But he did take issue with one thing in particular, and that is the problem of the U.S. deficit.
David, congratulations to you on a really interesting interview from which we all learned a lot. Look, I think it's pretty clear that markets have decided that they're pricing forward rates substantially higher than they were not very long ago. I didn't find anything to strongly disagree with in what Chairman Powell said, but there was a big Newfoundland of a dog that wasn't barking as he was speaking, and that's everything about the federal fiscal situation. That matters two ways. If there's more debt and much bigger deficits, that means more demand in the economy, and that raises the neutral rate now and raises even more the prospective neutral rate in the future. That's one important link. The other important link is that when you're trying to sell huge amounts of long-term debt because you have very big deficits, its price goes down, and that means higher long-term yields, a rising term premium. And I think you've got both of those phenomena going on, and realization that the neutral rate's likely to be higher because of fiscal policy and the supply absorption aspect. And I understand that the Fed's job is not to get involved in fiscal policy, but I think over time, the Fed is going to have to, as the monetary authority of the country, going to have to engage on some of these questions about Treasury debt, especially given the magnitude of its own balance sheet and the magnitude of the losses that acting as the agent of the Treasury and taxpayers, the very substantial losses that have been taken in a mark-to-market sense on the Fed's balance sheet. So those fiscal issues have to be at the center, it seems to me, of a discussion of interest rate issues.
So pick up on exactly what that means for the Fed, because Jay Powell didn't deny that, although he said there were a lot of factors. He thinks that's just one factor going into what's going on with the 25-year yield, for example, or 30-year yield right now. He said it's too complicated, he doesn't really know. But he said we have to take that as it is. It doesn't change our policy. If you were exactly right, and I assume you are, how does it change the Fed's policy, monetary policy right now?
Well, I think there are two separate parts of it. Insofar as the neutral rate is being pushed up by higher fiscal deficits, that's a thing that means the Fed has to raise the actual rate in order to keep the same degree of balance between the accelerator and the brakes. Insofar as the interest rate is going up because of some kind of term premium, and that's important, that's restraint that's being applied to the economy, that's the brake, and it might substitute for a brake the Fed would otherwise have to provide. So it's not enough for the Fed to recognize that rates are going up. It has to implicitly be forming a view as to what the cause is, and I don't think that's analytically easy at this point, and it's sort of the first rule of minefields to step gingerly. And I think the Fed's doing that in the signals they're sending that they're not likely to move in November and that December is uncertain. And I think that's appropriate. I think there was kind of a failure in markets. I've kind of been struck over the last several years by markets being a bit myopic beyond what's right in front of them. They were that way with respect to inflation. It seemed to me they were that way with respect to low, long rates in the early summer. And I think markets have to sort of recognize that the fiscal picture is going to be significantly complicating for some time to come.
On the question of the neutral rate, we talk about it a lot. I understand it's not directly observable, which is a challenge. But one of the things we talked about with Jay Powell was that back in August of 2020, he said that he thought that that neutral rate had come down from something like 2.5 to 1.8. This week, what he said when asked was, well, it doesn't move that much. He thinks it's somewhere around 2 or a little under 2. Does that sound right to you?
I'm not sure whether that's a reference to the nominal rate or the real neutral interest rate, David. My view would be that the real neutral rate is probably in excess of 1.5 percentage points, given the magnitude of deficits, and that inflation is probably going to tend, given everything that's going on, to be greater than 2. So I would think of the neutral rate that the Fed has been calling 2.5, inflation plus real, as probably being more in the 3.5 to 4 range right now.
And Larry, what do you make of the question about whether some of the turmoil in the bond market is really a potential risk for the financial system? We're seeing a lot of volatility, and of course the rates on the long end have gone up a lot. At the same time, the rates on the short end, as you know well, have not moved much.
Well, I think that that is because there's a set of questions about the absorption of all this long-term debt. The Treasury's selling massively. The Fed is selling substantially. The Fed, through its regulatory policies, is appropriately telling banks not to buy. Foreign reserve holders, for various reasons, are wanting less U.S. long-duration debt. So you have a supply-demand imbalance, and that's something that makes markets move. I think it is something that has to be watched very closely, and I think the Fed has an obligation to be ready to assure the liquidity and the functioning of the Treasury market. But as is always true, David, there's a difference between a volatile market in response to new information, when there's a lot of new information coming, and some of it may not be good. That's one thing. It's a quite different thing when you have a non-volatile, when you have an illiquid and not functioning market. I haven't seen evidence yet that that's where the Treasury market is, but certainly that's something that the Fed, and particularly its outpost in New York, needs to be watching closely.